Let me ask you about oil and gas, separately, downstream companies. So where do you stand on that now?
So the downstream companies are actually doing quite well. Within the downstream, we do think that they have done a good job by maintaining their marketing margin. And refining margin is, of course, it's a global thing. But global refining margins have been holding up. The good thing about these companies are that there was apprehension in our mind also that can they sustain this kind of marketing margin. To our surprise, they have. They're generating good cash flows. They're paying good dividends. The stock valuation is not as expensive. So this, the oil marketing companies provide some sort of stability in your portfolio. You need certain companies which will provide you very stable returns. Of course, their reported earnings are a bit volatile, but if you look through the inventory losses, just look at the core recurring earnings, that has been very stable. And valuation reasonable, good yield. So that's for the stable part of the portfolio.
Are you a supporter of this mooted plan, apparently, which is doing the rounds of upstream plus downstream merger, or does that scare you?
Well, I mean, I have to admit that neither me, I think most people do not know the contours of the plan, but based on what is being talked about, that ONGC buys out, HPCL's share from the government or something like that. If that happens without any management change, right? In that case, I don't see that as a big issue because HPCL operates as a independent company and so does ONGC. It just probably helps the government's fiscal balance at the end of the day. So currently, our sense is that all this M&A or consolidation talked about is more like investment-wise, not so operational-wise. So therefore, that should be all right. If it were to be operational-wise, then we need to step back and think it afresh.
Okay. And what about gas? Things like IGL or Petronet LNG. I mean, do you track that space?
We do track that space, but our sense is that the valuations in those spaces are quite expensive. And let me just spend a minute on this point, because I mentioned in the earlier that we are growth investors, and valuation, even if it's expensive, the growth will pay up. Now, we note that if you look at the companies that we named in the gas space, these are utility businesses. They have to deploy significant of capital for the next level of growth. So in our investment framework, we'll pay up if the asset turn keep growing. In those businesses, by nature of that may not be as easy. So therefore, I think gas businesses, we were bullish. We played them for some time, but currently in that space, I think the valuation looks very expensive in the context of the capital they need to put for future growth.
I mean, we've spoken for about 15 minutes on India, and we haven't said a word about infrastructure. That whole space, capex related, corporate capex, is it an avoid, or can you still take bets saying that maybe 4 quarters down the line things will start moving?
So that's a tough one, right? Because I think the corporate capex has been also poor, not just because of domestic environment, but also global commodity prices were quite low. That has changed about a year back. So as people get back confidence that this is going to sustain, we can see some amount of corporate capex comes back. But having said that, there are a lot of capacity already in the system, and we mentioned about the NPL issues. Those need to be resolved first. We hear from time to time that there are several committees working on it, so we'll see what happens. But even if you look back into the last bull market, 2003-04, what really sparked the capex cycle was the household capital formation, the physical real estate part. If we had this meeting, this interview about 2 weeks back, we would have said real estate also we are not seeing anything. But now that this scheme has come, we are very hopeful that it is the real estate which will kickstart the capital formation cycle. So therefore, if you want to play infrastructure, the construction companies, one could start by playing that real estate value chain. I think that is somewhere we are quite bullish. And real estate has a huge multiplier impact, right? That fuels demand of a lot of things. So maybe that going forward, maybe in 19, maybe in 20, can fuel further capex. And for big ticket capex to come back in steel, in refining, these global commodity prices need to be sustained. And for that, one needs to take a call how far and how serious China really is about the supply consolidation. We think it will continue. We think prices will remain quite solid, but it is the Indian corporate sector who needs to take that call. So
you would be more bullish on construction related to real estate rather than, say, infrastructure spaces like roads and ports?
No, we are bullish on roads and as well as housing. We would stay away from the let's say the corporate capex driven the stocks, sectors or companies so far, because so far there are no signs that they make a comeback. Because firstly, deleveraging needs to happen. After that, we can think of re-leveraging. I think if anyone with higher risk appetite wants to play that space, I think they need to look at deleveraging plays. They need to look at NPL resolutions, how that happens. After that, we can think about re-leveraging and corporate capex coming back.
What's your take on cement?
Well, cement has been a very favorite sector. It's a great play on the infrastructure and the roads and the housing that we're talking about. At the same time, corporate capex not happening is a bit of a drag. So therefore, within cement also, we look at companies which are somewhat cheaper, which have good regional exposure, the region that we like. And we also look at companies which can have certain operating and financial leverage. So those are the kind of cement companies that we like. Certain cement companies, especially the top ones, by now are quite expensive.
So what is your preferred solution to this NPL problem? Because if the market got a realistic, credible NPL solution today, the chances of a re-rating are far higher. What do you think would be the most acceptable solution? Because there are 2 or 3 which are being spoken about now.
Right. So I think the solution hinges on this one just key point. You can form an asset management company and whatnot. But what is the valuation of those assets today? And if the valuation is 80, not 100, as in the books, who takes that haircut? So that needs to be decided, and how the haircut is split between, let's say, the promoter, the bank, and other stakeholders. That needs to be very well understood. But our sense is that once that happens, the situation after that can be quite good actually. What we are not sure about, if there is a write down, how the PSU banks will handle it, because they are already quite weak on capital and they would definitely need more capital. So it is the government, and government is the ultimate owner of those banks. So they need to take a call on it. But should a call be taken and those problems are ring-fenced, haircut taken, after the banks are recapitalized, then the deleveraging play we spoke about, that will be like on in its full force.
So after such a strong start to the year, what's the biggest risk fear that you have? What could derail this kind of momentum that we have on hand right now?
Sure. So if you think about the global level, right, if I go back to November, when the US election happened, the fear was that we will see protectionist policies from US. So far, we have not seen that. Maybe the probability of those policies reduced, but it has not gone away. So one has to be mindful of that. And if that happens, that will not impact India so much fundamentally, but sentiment to the emerging markets can definitely sour. So that's number one we have to watch out for. Domestically, for around the GST implementation, we do expect some teething trouble to happen. Depending on which good is classified in which basket, there will be restocking and destocking. So I think that is something one has to watch out for. And then, of course, every year around June, July, we look towards the sky and watch how the rains are going to happen. Although we have to say that the importance of rain to the Indian economy has been diminishing, but still at the end of the day, after such a good run, it's a good, it is going to be a sentiment driver. So these are the 3 things that we are watching out for. But having said that, the themes that we mentioned, right, whether it is mid-sized private banks, whether it is wealth and asset managers, whether it is for organized sector gaining market share, or housing and road-related infrastructure companies, they have a very good long growth runway. So there may be some volatility from time to time, but we don't think any of these events, the risk factors you mentioned, alters the big picture 3-5 year growth outlook.
Rana, pleasure talking to you. Thank you very much for joining me today.